Hi Prabhat, welcome to NDTV Profit. Thank you so much for taking out time for us. Just wanted to first get a sense that last when we spoke to you before demonetization, India was one of the preferred market that you said for FIIs within Asia. Has that changed?
I think India still continues to be an overweight. Most people are looking at this as something will impact the economy maybe a couple of quarters and things will sort of head back to normal. So I don't think there is any change in preference. India was one of the preferred emerging market. I think continues to be preferred still.
Because of demonetization, do you think that FY18 numbers may really not see much change and that's why market is looking cheaper than what it was about 3-4 months back?
Yeah, so I think the fact is that markets have become cheaper compared to where they were at the peak in the recent past. More interestingly, actually, not only have the markets corrected, but the yields, which is the alternative sort of investment option in Indian markets, have corrected quite sharply, partly because of demonetization exercise, and partly because obviously inflation has been coming down, etc. So the fact is that it is first time in 5-6 years that we are seeing earnings yields versus the bond yields sort of starting to collide. Earnings yields have always traded at a premium, except once in FY13 very briefly, and then 2007 at a premium to bond yields. So markets have become cheaper. More expensive stocks in consumer, etc., have corrected more. So clearly, in terms of just valuations, we are sitting in a much more healthy space. And if earnings don't correct that much, obviously, sort of sets the stage for a decent performance going into FY18.
What do you think can be the impact on earnings from a near-term perspective, say in the next 6 months or maybe 9 months? What is the sort of impact that you see on earnings because of demonetization?
So two things there. One, that there will be an earnings impact is sure. But the sectors which are impacted don't really have that much of weightage in our headline indices. So we're looking at, for example, Sensex and Nifty, then weightage of sectors such as oil and gas, technology, metals, banks is much larger percentage than of the sectors which are actually going to see a significant change in earnings because of the slowdown that happens because of demonetization. Cement has got a 2% weight. Autos have got a 9 to 10% weight, out of which Tata Motors has a very large weight. So domestic autos weight is very small. And then you start looking at sectors which are seeing demand slowdown, you actually will be hard pressed to find them. So the fact of the matter is that while there will be a sort of more of an impact will be on discretionary demand, more which could actually linger on, but the representation of discretionary demand in the headline index is very, very little. Therefore, our view is that earnings, worst case might correct 3-4% from whatever the growth rate is forecast. So if you're forecasting 15-16%, we think a 3-4% cut to that growth is something that is the worst case scenario.
From markets or from Nifty or Sensex point of view, what you're saying is that the downside may be limited. But, whenever we see the recovery, the changes in the earnings, the changes in the pattern with which a lot of sectors operate may change quite meaningfully after such big exercises that we've seen in India?
That is for sure. I mean, the fact is that, for example, sectors which have which have fair amount of cash dealings, for example, at the front end will definitely be impacted. But the impact obviously depends on the impact of discretionary. How much discretion is there in the buying patterns? I mean, you don't expect, for example, a soap company, even though soaps are bought in cash, to get impacted because of this. But as you start moving towards a much larger sort of ticket items which are bought in cash, the impact starts to increase. And also depends on which geography you're sitting in, rural or urban. So urban impacts are lower, as we know, compared to rural. Some of these impacts obviously will be again transitory. I personally think that high-end luxury, etc., might have more lasting impacts, and the rest of stuff will probably come back more quickly. The sectors which are impacted on a more permanent basis could be informal sector, for example, because they need to change the way of working, they need to start paying taxes. They might not have a direct impact, really speaking, on the Sensex or index, but they could actually have some sort of indirect impact if they become there's too much stress, it come through a banking sector, sort of impact, or it could come through an impact in NBFC sort of credit rating through MSMEs. So I think what we have to sort of be mindful when we say that the impact on earnings is limited, we have to be mindful of indirect impacts that come through. And that is something that we'll have to sort of wait and see as to how this whole thing evolves over the next 2 to 3 quarter period. Our base case, economy view is that the impact is more transitory. Therefore, economy will bounce back to normal course of sort of growth in the calendar Q2, next calendar Q2. So you'll still have some impact in Jan to March quarter, but post that, things will start to normalize.
Actually, what you're saying does also say that if there is a good brand, a good business, which is done in an organized manner, that would actually benefit out of this exercise once we have the currency problem being solved?
Well, again, yeah, it's possible. I mean, I think the nature of, first of all, there are no Indian high-end luxury brands. I think the brands are more sort of always mass market in India. So you're right, those brands could benefit at the expense of the informal sector, for sure. Yeah, absolutely.
Banks and NBFCs have seen a correction. Do you think that this correction is a buying opportunity, or businesses of some of these NBFCs and banks may really take a big hit?
So first of all, banks per se the big banks did not correct. It's NBFCs which have corrected, right? Because some of the PSU banks are up actually post demonetization. Now, NBFCs largely are financing either SMEs or they're financing consumption, discretionary consumption. They could be financing two-wheelers, they could be financing, consumer durables, they could be financing trucks. And the problem is that the segments which are impacted the first because of any demonetization exercise is essentially these segments. Secondly, there are NBFCs which operate in rural areas, which have cash collections. So, compared to banks, the impact on NBFCs will be larger, and that's the reason why you've seen NBFCs correct a lot more than banks. And I would think that it'll probably be a slightly longer term impact, in the sense that it might run for 2 quarters, maybe slightly longer. And while banks will be actually sitting much more pretty, I think, because they might have some marginal stress in asset quality, but they're benefiting a lot from cost of funding, treasury gains, etc. So preferred place in the short term actually will still be banks rather than NBFCs in the short term.
Do you think banks which are getting excess liquidity now, the loan demand has also contracted quite a bit, and that's why even though the cost of funding is coming down, their NIMs would contract because the loan opportunity may not be that high?
Well, that is right, and that might continue for about 1 quarter or so, because end of the day, when the economy slows down, like it has slowed down now, and if the demand is less, the inventory financing also will go down. But I think that demand will probably start to reaccelerate back, because when something like demonetization happens, then you will have the ability of the system to hold inventory goes down. Therefore, and I'm sure there are a lot of repayments which are happening, in terms of people paying back their loans in old currency. All that might sort of start to will bottom out hopefully in the first quarter, and things will start to look up in terms of loan growth. So I'm not that bearish on the loan growth being completely dry. I think there are obviously reasons which are leading to this kind of slowdown in loan growth all of a sudden. Some to do with demonetization, some and I think those will essentially move off over a couple of quarters.
Digital banks, digital wallets, what does any bank do on the digital side? Do you think that will play an important differentiating role versus the sector or what some of the other players are doing, which in turn could mean that it could become a good buy if a bank is doing very well on the digital side?
So I think, it could be a trend. Though it's sort of, at this point in time globally, I think it's hard to see, except a couple of examples, how big this can become. So it could become big, and it probably will become big simply because if the more and more merchants essentially move to a sort of a system which allows them to take digital payments, it's quite likely that wallets will become larger. And there I would think that private banks will probably have an edge because they are far more advanced in technology compared to PSU banks.
Consumption stocks have fallen. and consumer durables, consumption names, all have seen a fall. Do you think that this fall is a buying opportunity? Because once the currency is back, once people get their income stream back online, it will really not matter much in terms of demand?
So there has been a lot of correction. In fact, the thing is that staples, which are the most defensive of all in terms of demand, have corrected a bit more than, for example, autos, which have more discretionary demand. Their demand hits have been higher. And that probably is because of the fact that these stocks in consumer sector were expensive to begin with. And I think that's the reason why our report has come out, because we think that the demand normalization in sectors such as FMCG will be the fastest, while we are not getting these stocks at much more reasonable valuations. So that's why I think we sort of like it, because this is the first sector which normalizes in terms of demand growth.
Just taking an example of an Asian Paints, every time that they have seen such problems of low demand or high raw material costs, they have passed on the hike and volumes have not gotten impacted, or volumes after a point of time tend to recover. Do you think that can happen again now for very strong brands?
So I think one thing you need to differentiate is margin picture versus actual demand. Because when you say that you bounce back from a margin hit because you have a strong brand, therefore ability to pass on, is a different thing from saying if your demand itself sort of corrects. So, I can't answer you directly in terms of just because it's a very stock specific question, but my point simply is that what you need to figure out is what will happen to demand eventually. It sort of goes back to normal in 2 quarters. Obviously you should be looking at the stocks. But, when you talk stock correction in context of brands, you probably typically mean that when last time, when the crude prices rose very, very fast and there was an increase in raw material costs, margins got compressed, and that's why the stock fell. But you're not saying that sales growth really slowed down, because at the end of the day, the ability to protect margins is what brands gives you. But if your growth itself is impacted because of some reason which is slightly more permanent, then it's a different situation. But as I said, I mean, one has to look at case-to-case basis and make a judgment on this point.
How would you look at infra? With SME businesses now coming fully into the banking space, do you think the loan demand from some of these SME sectors would tend to increase quite a bit, and that could also lead to a little bit of capex recovery?
Because we'll have to wait and see, actually, because the capex is a process which is driven by the capacity utilization rather than so it's driven by what the entrepreneur sees in terms of his demand. If he sees demand sort of increasing for his product and he sees himself running out of capacity, or a corporate for that matter, they go and invest in capacity. The fact of the matter is that demonetization, while it might get people into the organized space or funding, the first impact of demonetization is slowdown. So I think capex pickup just because people come back into the system is something that I would sort of not hang my hat on. What I would like to see essentially is that because of demonetization, the cost of funding falls, therefore demand picks up, and therefore people start to invest. That is probably a more likely sequence of events rather than just access to funding.
Were you surprised by what RBI did? And looking at the cost of funding coming down since about 2014, 2015, a lot has been done, but still the 10-year bond reflects as if there could be more cut on the interest rate side?
That is what we think. I mean, more than RBI, we think that the fact that system liquidity goes up a lot will essentially mean that banks will pass on some of these benefits of lower cost of funding onto their consumers.
Can you just explain our viewers that how cost of funding would impact and what could be the lag effect before we start to see any impact on earnings?
So obviously, every cut in interest rates will generate high risk appetite, and therefore, with a lag of 5-6 months, you will start to see a pickup for demand for funds. Now, it could happen in different fashions. For example, lower rates could tend to people start to buy more automobiles, and therefore automobile companies start investing. Lower cost of debt for infrastructure companies could mean that their break-evens have become lower, break-even returns have become lower, and that starts the process of investment. It could also mean that house buyers find the cost of housing much lower on an EMI basis and start to invest. So it could have multiple impacts, but these impacts only happen with a lag over a period of time. So typically lower interest rates do lead to a pickup, but it takes, and the context is very important, because if lower interest rates are happening because the economy is collapsing around you and therefore demand for money is falling, is a different context. In the context of a picking economy which is picking up, if you get lower rates, then it sort of pushes it upwards further. And that is quite likely, it's possible, but you got to wait for about 5-6 months and a year for this impact to be fully come through in the economy.
For metal stocks, what will be your view? Dollar index has gone up, but underlying metal prices have also gone up, which is something which we've not seen earlier. Metal stocks have rallied. Do you think there is more steam left, and this correlation between dollar index and metal prices is telling that this time it's something different?
So that's something that I sort of haven't got right, because but the fact is why it has happened, I think, is because the view on China has become slightly more positive, and that there have been cutbacks. For example, oil is because of cutbacks by OPEC, or metals is the same thing. There have been cutbacks in capacities. But this is a trend which happened despite the fact that the growth in China was slow. US doesn't impact metals that much, frankly. The engine is entirely on this side of the globe rather than on that side of the globe. So at the margin, obviously, more positive signals from US emerging, but the metals had started rallying much before the Trump election, for example. So whether that could continue, I think we've probably seen a lot of that rally happen already, and the prices are such that producers are starting to make decent money. So I personally wouldn't think that there'll be a continued sort of rally from here, but definitely it's been a surprise personally for me.
IT and pharma have also seen a little bit of correction after demonetization, but these are businesses that don't have a lot of cash involvement, and that's why probably 6 months down the line they would probably trade at similar multiples, or what's happening there.
Yeah, I would guess so. I mean, in the sense that obviously in short term markets tend to rotation in markets tend to happen, because if for example you're seeing slow down the economy, you'll go and buy defensives. But the impact on the fundamentals of pharma and IT will be very limited, if any. Actually, there'll probably be no impact. So they will not see any loss of earnings or change of earnings. The change of multiples happens because people are sort of maybe doing sector rotation, given what is happening in the economy. But eventually, let's say in 3-4 months' time, things will revert back to normal in terms of how people look at stocks with each other, because the fundamentals of other part of the economy will start to stabilize.
Thank you, Prabhat, so much for taking out time for us. Always a pleasure talking to you.